Today, we're diving into a fascinating financial puzzle, one that really seems to defy logic. We're talking about a company that's trading for almost half of what its assets are actually worth. This is the story of Dundee Corporation, and it's a deep dive into value, risk, and one very, very big discount.
So let me just ask you this. What if you could buy a dollar for just 50 cents? I mean, it sounds impossible, right? A total no-brainer. But in the wild world of the stock market, these kinds of situations can and actually do happen. And that's pretty much exactly the scenario we're looking at today.
At the heart of this whole mystery is this number right here, roughly 47%. That is the massive, jaw-dropping discount to its own asset value that Dundee Corporation is trading at. A gap this big, well, it just begs for an explanation. Okay, so let's put some real numbers to this. The company's assets, what's called its net asset value, or NAV, are worth about $8.28 for every single share. But if you go to buy a share on the market, it only costs you around $4.35. And there it is, right out in the open. That's your 47% gap.
You know, the easiest way to wrap your head around this is to think of it like a shopping basket. Imagine all of Dundee's assets are just a collection of different stocks, all sitting there in a basket. You can see the price tag on every single item, you can add it all up, and you know the total value. But for some reason, the market is letting you buy the entire basket for almost half price. It's wild.
So to figure out why the market is offering this crazy sale, we first need to take a peek inside that shopping basket. What exactly is Dundee Corporation? And what is this net asset value thing we keep talking about? Okay, so this is absolutely crucial to understand. Dundee is what's known as a holding company. This means they don't actually dig gold out of the ground themselves. Nope. Instead, they act like an investor, buying and holding shares, or equity stakes, in a whole bunch of other mining companies, mostly smaller ones. So if they just own shares in other companies, how do we figure out what they're actually worth? Well, that's where NAV comes in, and it's a pretty simple three-step process. First, you just identify every single company they own a piece of. Second, you look up the current market price for all of those shares. And third, you just add it all up. That final number, that is the net asset value. It's the real-time value of everything in their basket. And look, this isn't just some fancy theory we're throwing around. It's the fundamental way the market is supposed to value a company like this. As the source material says directly, the market values it based on its NAV. So, we know what it should be worth. The question is, why isn't it? And that brings us right to the core of our investigation. If we know the NAV is sitting around $8.28, why on earth is the stock price stuck way down at $4.35? Let's start peeling back the layers and see if we can find the real reasons for this enormous 47% gap. Now, to be fair, it's pretty normal for holding companies to trade at some kind of discount to their NAV. People often call it the holding company penalty. But here's the thing. A small discount, say 5 or 10%, that's one thing. A gap of nearly 50%, that is, as the analysis points out, exceptionally steep. Something else is definitely going on here. When you really dig into it, the market's concerns seem to boil down to three main culprits that are driving this discount. You've got the inherent risk in their portfolio, a shaky track record from the past, and the fact that some of their assets are just plain hard to sell. Let's break each of those down. Okay, so here's the deal. First, Dundee's portfolio is packed with junior miners. These are small, often unproven exploration companies, and they are inherently risky. Second, about 90 cents per share of their value is locked up in private investments. You can't just sell those on the stock market tomorrow. And finally, the company has had some struggles in the past, and the market hasn't totally forgotten. It's basically in prove-it-to-me mode with them. All right, so those are the problems. That's the story the discount is telling us. But what if those exact same risks are also creating a massive opportunity? Let's flip the coin and look at the other side, the bull case, especially in a world where gold prices are taking off. The key to the whole bull case is this concept called second-order leverage. Now, what the heck does that mean? Well, in simple terms, it means a rise in the price of gold could have a multiplied or supercharged effect on Dundee's value, way more than it would for a regular old mining company. Let's put this side by side. It makes it super clear. A traditional miner, like a Barrick, owns physical mines. Dundee, on the other hand, owns shares of other miners. So when gold prices skyrocket, a big miner's profits go up. But for Dundee, the stock prices of those little junior miners they own can absolutely surge because their potential fortunes are so sensitive to the price of gold.
This could cause its NAV to rocket higher, all while you bought in at that massive 47% discount to its current value.
So when you put this all together, what's the actual investment thesis here? I mean, what do you really have to believe for this to be a winning bet? First and foremost, let's be crystal clear about this. The source material paints a very direct picture. This is an aggressive, high-risk, high-reward kind of play. This is definitely not some slow and steady, sleep-well-at-night investment. The potential upside here is matched by some very real risk. So if you're gonna bet on Dundee, you're really making a two-part bet. First, you have to believe that those junior mining stocks it owns are going to catch fire in a gold rally, pushing that $8 NAV way, way higher. And second, you have to believe that the company's management is going to do something, like buying back their own super cheap shares to force that 47% discount to finally close. And that, of course, leaves us with the final multi-million-dollar question. Is this massive 47% discount just a giant warning sign, a deep value trap waiting to spring on unsuspecting investors? Or is it the market completely overlooking a powerful combination of assets on the verge of a massive re-rating? Could this be the opportunity of a lifetime?